From 2020 to 2022, some of the worst investment decisions imaginable absolutely printed money. I'm talking about Dogecoin millionaires, Shiba Inu yacht parties, and guys who thought PE ratios were something you wore in gym class, outperforming Ivy League finance graduates who actually read company earnings reports. So why do bad investors often beat the smart ones? Well, buckle up, because the answer is dumber, wilder, and more hilariously true than you think. And by the end of this video, you're going to understand exactly why Dave, the guy who thought Luna was a planet, probably made more money than your 401k last year. Quick disclaimer, this isn't financial advice. It's for education, entertainment, and making you laugh while reevaluating your entire investing strategy. Let's ride. 1. The Dunning-Kruger Effect, where confidence beats competence. Meet Dave. Dave is what you get when you mix just enough information with way too much confidence. He watched half a YouTube video on candlestick patterns and now thinks he's Gordon Gekko with Wi-Fi. He doesn't understand macro trends, discounted cash flow, or what a balance sheet even is. But what Dave does have is pure, uncut, unshakable confidence, and in a bull market, that's all it takes. This is the Dunning-Kruger Effect in action. The less you know, the more you think you know. And when the market's going up, confidence pays better than competence. But here's where it gets good. Dave's not just winning because he's overconfident. He's winning because of the types of stocks he naturally picks. 2. High beta mania. Why volatility makes bad investors rich temporarily. Dave doesn't like slow, boring companies like Johnson & Johnson. He wants rockets. So what does he invest in? High beta stocks. That's fancy talk for stocks that move more than the overall market. If the S&P goes up 2%, Dave's meme coin of choice might go up 8%. And Dave? He doesn't know what beta is. He just knows when a chart goes vertical, you buy now and vibe. In a bull market, these high beta plays absolutely crush. And because Dave is blindly throwing darts at anything shiny, he's accidentally outperforming Wall Street analysts with Bloomberg terminals. But here's the catch. Beta cuts both ways. When the market drops 2%, Dave's portfolio drops 10%, and suddenly he's blaming the Fed, short sellers, and media manipulation, basically anyone but himself. So why does this keep happening? Because Dave's secret weapon isn't technical analysis, it's something even dumber. 3. Ignorance equals diamond hands, and that's terrifyingly profitable. Smart investors, they know what can go wrong. They see macro risk, company debt, inflation, geopolitics, all of it. Dave? Dave just sees rocket emojis. When prices dip, the smart investor reevaluates. Dave, on the other hand, just screams "Heidel" and holds with the grip strength of a caffeinated gorilla. He's not strong. He's just uninformed. And that blind loyalty? Ironically, it works. Because if a volatile asset rebounds, who benefits most? Not the guy who sold after a 20% dip, but Dave, who held through a 70% nosedive without even blinking. But how did Dave even get into this situation in the first place? That brings us to the most dangerous force in the market. 4. The meme economy. Why viral hype beats financial literacy. GameStop, AMC, Dogecoin, Pepe, Bonk, Banana Coin. Okay, I made that last one up maybe. In the meme economy, logic is irrelevant. Virality is king. The worse the fundamentals, the better the meme. And Dave? Dave is fluent in meme. He doesn't need a financial statement, he needs a trending TikTok. The moment something starts mooning, Dave's in. Not because of deep analysis, but because someone with anime in their username tweeted, "Fart coin to $10." In this environment, a clever meme plus momentum equals more alpha than a CFA. It's not about being right, it's about being early to stupid. And speaking of being early, this next point might make you rethink your entire definition of a bad investor. 5. No plan, no problem. Why lack of strategy accidentally pays off. Smart investors love strategy. Entry points, exit plans, risk profiles, asset allocation. Dave? Dave buys whatever his friend Chad mentioned in the group chat and sells when his portfolio makes a sad face. But here's the twist. By not timing the market, Dave avoids a ton of self-inflicted wounds. He doesn't overthink earnings. He doesn't panic sell after a minor dip. He just buys and forgets. That's right. Dave is accidentally practicing long-term investing, the same strategy Warren Buffett preaches but with none of the wisdom. And in a rising market, that naivety often beats the guy who's constantly tweaking, optimizing, and second-guessing. Now, halfway through, if you're starting to wonder if you're actually Dave, say hello in the comments if you found this point useful. And don't worry. We've all been Dave at some point. The key is to learn from him without becoming him forever. Now let's talk about the dark side of outperformance. 6. Survivorship bias. You only hear from the Daves who won. For every Dave who turned $5,000 into $100,000 flipping NFTs, there are 1,000 Daves who lost everything and are now quietly updating their resumes. But here's the catch. The losing Daves? You don't hear from them. They're not on TikTok. They're not flexing screenshots. They're ghosting group chats. So the illusion is everyone is winning except you. In reality, you're just watching the highlight reel of survivorship bias. It makes reckless investing seem genius because the losers disappear. But here's the plot twist. Even if Dave wins, he rarely keeps it. Why? 7. Reversion to the mean. Dumb money gets smart money problems eventually. Every bull market eventually ends. Every meme hype cycle eventually crashes. And every overconfident investor eventually meets a reality check. When the tide goes out, as Buffett says, you see who was swimming naked. Spoiler alert, it's Dave. It's always Dave. Reversion to the mean is the financial equivalent of gravity. What goes up irrationally comes down brutally. Dave's 10x becomes a 2x. His 2x becomes break-even. His break-even becomes a tax write-off, and by the end, he's the guy telling you crypto is a scam while looking for a side hustle on Fiverr. But here's the real kicker, and it's why this whole topic matters more than ever. 8. Smart investors lose. Because they try to be smart in dumb markets. Smart investors are often too rational in irrational times. They want fundamentals to matter. They want valuations to mean something. But during speculative bubbles, logic is a liability. They sit on the sidelines while Dogecoin does a 30x. They short the market at the wrong time. They miss out, not because they're wrong, but because they're early. And in investing, being early is the same as being wrong. But here's the upside. Smart investors do win in the long run if they can survive the short-term stupidity. And that brings us to the lesson buried under all the memes and madness. 9. The real takeaway. Combine Dave's simplicity with actual discipline. If you want to beat the market, you don't have to be a genius. You don't have to catch every hype wave. But you do need consistency, conviction, and a little bit of Dave's dumb luck. Here's the winning combo. Pick long-term themes you understand. Automate your investing, aka forget it like Dave does. Avoid emotional decisions. Stay humble during bull markets. Stay sane during bear markets. And never risk money you can't afford to lose chasing Twitter threads. If you can take Dave's simplicity, remove the recklessness, and add some strategy, you'll outperform most retail investors and sleep better doing it. So why do bad investors beat smart ones? Because the game doesn't always reward the smartest player. Sometimes it rewards the one who plays the dumbest moves at the right time. But here's the good news. Dumb luck is not a requirement. You can win with discipline, patience, and just enough chaos to keep it spicy. If this video gave you a better perspective, or at least made you laugh and cry at the same time, hit that like button like it owes you money. Subscribe for more fast-paced, BS-free financial wisdom. And if you've ever pulled a Dave move yourself, drop it in the comments. We're all friends here. No shame, no suits. Just progress. Catch you in the next one. Keep stacking smart. And remember, loud money is often the dumbest money.